Hey everyone, this is Matt with the Fundamental Investing Institute. Welcome to this week's Fundamentals Unfiltered. Normally August is a pretty slow month for financial news, but 2025 might be the exception. Big news this week, over the last week anyway, is that Fed Chairman Powell had his speech at the Jackson Hole symposium. This is a symposium put on every year by the Kansas City Federal Reserve, and really going back to the early 80s, it has become it has become a national and even international event. Kind of an interesting thing as to why it is in Jackson Hole, Wyoming, is because former Federal Reserve Chief Paul Volcker was a big fly fisher. And apparently this is a part of the country that has great fly fishing. So in any event, Chairman Powell's speech was highly anticipated. And I think the markets were focused on some indication of a September rate cut. He certainly provided that indication, suggesting that the Fed is really viewing tariffs as a one-time price movement rather than something that is possibly going to cause persistent inflation over time. So that certainly increased the odds. The federal funds rate right now, the target federal funds rate is between 4.25% and 4.5%. So if we do get a 25% basis point cut, that'll bring the target rate down to 4 to 4.25%. I know Treasury Secretary Bessent has suggested that a half a point decrease would be warranted. I don't know about that. I think a quarter is more likely, but in any event, you got to remember that earlier in the month, the consumer price index came out, and that was a little bit under anticipated, but the producer price index came out shortly after, and that was higher than anticipated. In fact, that was hovering around 3%, a little better than 3% actually, and that can kind of indicate that higher prices are coming into the pipeline. So that threw some cold water on the possibility of a rate cut, but Chairman Powell's speech sort of enhanced the probability that next month we will get a rate cut. Markets responded favorably. The major stock market indices were up on Friday by a significant amount. But I think the bigger takeaway, in my opinion, is that the Fed had shed this very flawed policy framework, in my opinion, very flawed policy framework that they put out back in 2020. And I think some history there is important. So it's what we're going to talk about today. Now, the framework that came out in 2020 made two major changes to economic orthodoxy. They kind of sounded like semantics, but they were very important. The first is that the Fed indicated that it would target 2% on average as opposed to 2% per year. And what that meant is that if the Fed had a period of inflation that was significantly below 2%, they would accept higher than 2% inflation for some time, so that it averaged out. Now, they did not indicate over what period of time that average would be calculated, so there was always some uncertainty there. But that was a major change, in that the Fed was willing to accept higher than average inflation for a time. And then the other thing is they indicated that they would accept tighter labor market conditions. And remember, if we go back to 2019, 2020, the unemployment rate was well below 4%. I think it was maybe 3.25%, 3.5%. So it was well below 4%. And historically, a 4% unemployment rate, number one, is considered full employment. But the idea is that if you go much below 4%, that it sort of is a precursor to higher inflation. It's an indication that the economy is overheating. So that was always a threshold that the Fed used to think that inflation is coming down the pipeline. So these two changes in 2020 were very important. And there's a lot of different views, but I think that the Fed having this framework in place when inflation began to hit in 21 really kept, number one, it increased inflation expectations, but it also kept the Fed from acting sooner, which led to a much shorter period of time in which interest rates reset. And of course, we knew that was going to happen once inflation was getting out of control. And to go a little bit into the history of this, in the late 90s, the Fed was pushing towards more transparency. This was in the late 90s, early 2000s. Ben Bernanke became chairman in 2006. And one of his goals was to make the Fed more transparent. He thought that there would be some huge policy benefits to that. It'd make monetary policy more effective. One of his big pushes, he and along with many other economists, was this idea of embracing an explicit inflation target. This is not something the Fed had done before. And so in 2012, the Fed issued its first, what's called a Statement on Longer Run Goals and Monetary Policy Strategy. And the idea is that it gives markets and consumers and anyone paying attention a better sense of how the Fed interprets its dual mandate of price stability and maximum employment. And in that statement, the Fed, for the first time, put on paper its 2% inflation target. So a lot of people ask, why 2% and not 0? And there's really two main reasons for this. One is, by 2%, the Fed gives itself a little bit of margin of error to the upside to prevent deflation. Deflation is a persistent decrease in the price level for a lot of different reasons. Deflation can cause financial havoc, so the Fed wants to avoid that at all costs. It's a source of controversy like anything else, but nevertheless, 2% gives them a little margin of error to the upside. The other reason, and really the more important reason, is that the Fed wants to create an inflation premium in interest rates. And this gets down to what we call the effective lower bound. You would hear that a lot in the 2010s. And all the effective lower bound means is that if the federal funds rate is at or near 0, then that policy tool, which remember is the Federal Reserve's most important policy tool, it's their go-to policy tool, if it's at or near 0, if a recession happens, they don't have a lot of ammunition. They would have to rely on unorthodox policies, which they can do, but would prefer not to. So the idea is that if you get inflation expectations at 2%, then interest rates should always have, short-term interest rates should always at a very minimum be at 2%. And this gives them room to lower the federal funds rate in the event of a recession. If you look at how the Federal Reserve has acted historically during a recession, they cut very aggressively. They cut 3-4%. But in order to do that, you have to have a positive federal funds rate. So what happens is, if you get into a period where the economy is relatively strong, and yet the federal funds rate is at this effective lower bound or at near 0, if a recession happens, the Federal Reserve can't do much, or at least they can't do much with that policy tool. So they're trying to avoid this, and this was one of the reasons why you would have an inflation target as part of this, as part of their policy tools. And in the 2010s, inflation was consistently running below 2%. And this despite having a strong economy, this despite having very tight labor market conditions. And the reason is inflation expectations were also very low. And this is an important thing. So when the effective federal funds rate was at this near lower bound, there's very little the Fed would have been able to do if a recession hit. So this leads to their policy review, because when this policy statement came out in 2012, the Fed said that they would review it periodically, and so the conditions of the 2010s really led them to rethink things. They thought it was a very good time to do that. So specifically in 2019, the Fed did something called Fed Listens. And what they did is they went around the country, they talked to a lot of labor leaders and community leaders, and what they found, and I think it's a very good idea for the Federal Reserve officials to get out there and actually talk to people in these various communities. And they were specifically looking at lower income working class communities. And what they found is that despite having tight labor market conditions nationally, you have huge variations across the country, which of course I think, most people understand, but maybe Fed officials didn't really appreciate that. So the idea was that even if you have very low unemployment on the national scale, you can have huge variations. I mean, some communities are in almost Depression era conditions, and I would argue it's certainly one of the reasons why we've had so much economic populism in the last decade or so. So the Fed Listens, along with some other tools of their review, really led the Fed to kind of increase the maximum employment side of their mandate. So this leads to the 2020 policy statement that was rolled out at that year's Jackson Hole Symposium, which was virtual because of COVID. And I think a lot of us who are schooled in orthodox monetary policy were very nervous about having this new framework in place, but it's also understandable given the conditions. We had a strong economy, a tight labor market, and yet inflation was not doing what it was supposed to do. And having the federal funds rate at this effective lower bound really bound the hands of the Fed if you end up with a recession. So this leads to the 2020 policy statement. Of course, the pandemic hits, and you have all of these supply chain problems. You have fiscal stimulus, checks that are going into the hands of American households in various rounds. And I think the fiscal response should warrant some further discussion in a later show. We'll do that. But for now, we'll just say that you had a lot of fiscal support, probably too much in the later rounds of the fiscal stimulus. And the other thing is the Fed had a huge surge in the money supply. They responded very aggressively, and this is an important point, is that historically we've defined inflation as too much money chasing too few goods. And one of the things that happened really throughout the 90s and into the 2000s is that in the short run, the link between money supply growth and inflation was not very obvious. But economists, for the most part, thought that in the long run, monetary growth would be inflationary. Excess monetary growth would be inflationary. So this is an important point, is you had this huge surge in the money supply. You had a lot of fiscal stimulus. You had supply chain problems, and everything kind of coalesced, and we saw inflation. And initially, Fed officials, as well as a lot of private economists as well, called this transitory. They thought that, well, the supply chain problems will work its way out, and that the conditions of 2010 in the 2010s would return. That proved not to be the case. And of course, as inflation persisted, it really hit labor, because all of the wage gains that were generated in the 2010s went away. Inflation increased far faster than wages, hit American households really bad. And now the price stability side of the Fed's mandate went up, and the Fed had to engage in this huge interest rate reset. And I'm amazed it hasn't done more havoc than it did. I think there was over $4 trillion dollars of commercial real estate debt that was resetting, and it's just been pushed off. But there were a lot of potential financial problems. Some materialized, like the Silicon Valley Bank fiasco, but a lot of them didn't. It was actually kind of surprising. But the point is, and I'm going to leave you with something the Fed chairman said. He said, "We cannot say for certain where rates will settle out over the long run, but their neutral level may now be higher than during the 2010s, reflecting changes in productivity, demographics, fiscal policy, and other factors that affect the balance between saving and investment." This is the line that I highlighted, and I thought was the most important, because I am very skeptical of the idea that credit conditions in the 2010s can persist. I think it was a little bit of a blip in the global economy. So, we know that there are a lot of commentators thinking that a federal funds rate at 0 or 1%, 1.5% will be the norm. I don't see it. I'm skeptical. As investors, our job is to filter out the noise and focus on the signals, focus on the fundamentals. And my point is, I think moving forward, we should view rate cuts positively. They're probably coming down the pipeline, but I would recalibrate my expectations and think that maybe the new normal is something closer to the old normal. I would not be factoring in near zero interest rates as some people are doing, I guess is my point. So with that, I'd like to talk in future shows more about the inflation of the last 2 years, the monetary and fiscal conditions. But for today's show, I really wanted to talk a little bit about this huge change in this new statement of policy that the Fed put out, because they are reverting back to a more orthodox policy stance. And I think that anyone who's affected by interest rates, not just as consumers, but as investors, we're using interest rates to discount future earnings. We're thinking about how leverage plays into the individual assets that we own, and maybe leverage on our portfolios in general. But certainly, interest rates are important, and we need to understand credit conditions. As always, we need to focus on the fundamentals. And with that, I will leave everyone until next time. If you like our content, please hit like and subscribe, and you will be in the loop as new content comes out. Thank you.